Welcome back to BizarreTrades. In this video, I'm going to show you how trading options compares to trading stocks. So tonight, April 2nd, 2020, Tesla reported their deliveries for the quarter and they exceeded the expectations of the market. So at closing, the Tesla stock was trading at $454.47. Okay, so after market hours, he actually rose all the way up to $535. So in this example here on the left, we're going to assume that we purchased the stock straight out, 100 shares of Tesla for $454.47 each. And that would have cost me $45,447. Now, we're going to assume that I sold these 100 shares at the current price and the current aftermarket hours price of $535. And according to this calculation, my profit would have been $8,053, which is 18% return on a $45,447 investment. Now, let's look over to the right, the options calculator that I developed. And we're going to enter the same details here, utilizing the closing price. And we're going to put it here as the current stock price, right? Because that's our starting price. And we're going to select the strike price. Looking over here, this screenshot came from the CBOE website, and we're going to select this strike price here, the 455, because it's the closest one to the strike price, right? So we're going to select the 455 strike price. Okay. Now we're only going to purchase one option, one contract, and as I mentioned in a previous video, when you purchase when you purchase an options contract, you control 100 shares of the underlying stock. What this means is that you can exercise this option at any time and purchase the stock right out at the strike price. So if Tesla right now, for example, is trading at $535, if you choose to exercise this option, you can purchase the shares at $455, even though the current price is $535. Okay, and that would be 100 shares of Tesla. So, but in this example, we're going to purchase just one contract. Okay, now the share price, if we look over here to the right, for the strike price of 455, it would have cost me 15.6 per share to purchase this contract. So that means you multiply this times 100 because we do control 100 shares of the underlying stock. So we're going to enter 15.6 here, and the spreadsheet tells me that that contract option would have cost me $1,560. Okay, now moving on to the delta. So the delta here for the strike price of 455 is 0.4966. We're going to enter that here. Now, if you don't know what the delta is, it's simply put, every time the stock moves up $1, this is how much you earn per share. So in other words, if the stock moves up from 454.47 to 455.47, you're going to earn 0.4966 per share. So that means that you will earn this times 100. So you will earn 49.66 every dollar that this stock goes up. Now let's say it goes up from 454.47 to 456.47. So that's $2 that it went up. So that means that you will earn this times 2, correct? But in addition to that, on the second dollar, you will begin earning gamma. And we're going to look at the strike price here, 455, all the way across. And it says the gamma is 0.0107. So on the second dollar, you begin earning gamma. Okay, so on every dollar, moving away from your from the current strike price at the moment that you entered this position, you earn delta. Beginning the second dollar, you will begin earning gamma and delta. Okay, so It's a little messy, and I apologize, but it takes time to understand this stuff, and this is the reason why I developed this calculator to make it easier for me. I don't like to waste too much time on this stuff. I just want to know the numbers right away and have a clear snapshot of where I'm headed when I'm entering a position. Okay, so now I'm going to enter here the exit price, which is going to be the aftermarket hours price of 535. And what this calculator reveals to me is that on my investment of $1,560, my profit would have been $4,085 or 261% compared to buying the stock right out at $45,447 to make $8,053. And it's obvious to see that the better choice of this investment would have been the options. Now, if I had purchased two contracts, it would have cost me $3,100, but my return would have exceeded that of buying the stock right out. See that? So this is one of the reasons why I'm more attracted to trading options than trading stocks. It costs a lot less, but it returns a lot more. Now, of course, some things, if it's too good to be true, then it probably is. Well, I mentioned in my previous video that there is a catch, and the catch is the theta. The theta is the time decay. Okay, for every day that you hold the option until expiration, it loses value, and the value is set on what they call theta, and I don't have a screenshot of that here, but your contract, every day that it approaches expiration, it loses value based on that theta dollar amount. Okay, so you have to be aware of that. The theta varies depending on which option you're trading. If you're close to, say, earnings, the theta is much higher. If you're close to expiration, the theta is much higher. So it all depends. You have to have a plan when you get into these in these trades with options. So that's it. There you have it. I just wanted to show you, compare the the trading stocks versus trading options, and to me, trading options is a more viable way of making money in the stock market. So I hope you enjoyed this video. I hope it was clear enough for you to understand, and let me know what you think about the video. Leave me a comment, give me a thumbs up, thumbs down. If you haven't subscribed yet to this channel, make sure you do subscribe. Hit the bell button so that you are notified every time I upload a video, and take care. Till next time.